Hey everybody, it's Andy Wilt here over at the Wilt Group at People's Mortgage, and I hope you're doing well. Today is April 8th, and I wanted to try to help you understand what the heck is going on with rates. Other than the lack of inventory, I know the pace at which rates are rising is about all that anybody can talk about in the real estate world. So I wanted to do my part in at least trying to help you understand what's happening in the world of rates, something you could share with your clients. I am not an economist, but I will do my best to share with you what I see from my seat here in the origination world in lending. So with that, I prepared a couple of slides I wanted to go over with you. I'm no professional presenter, but I'm gonna do my best here to share my screen and kind of review this stuff with you guys. So just give me 1 second here and I'll see if we can't do it. How about that? I got it to share. Okay, so what you're looking at here is a chart of inflation. This is the main driver. This is what is causing interest rates to rise to the level that they are. Because as if you're a subscriber to our weekly economic update that we deliver by phone, you know that we talk all the time that inflation is the root enemy of long-term bonds, and that can be treasuries, and it also relates to mortgage-backed securities. That's where interest rates come from. Mortgage-backed securities are a traded commodity. Every day, the rates change based on what's happening on the markets. Not directly connected to what the Federal Reserve does. The Federal Reserve controls the monetary policy, how much money or what the charge rather is between the banks for exchanging of money. All right, so when the Fed raises rates, it doesn't impact the mortgage world directly, rather indirectly. And I'm going to talk a little bit more about that and try not to dig myself into a hole because, as stated before, I am not an economist, just trying to relay some concepts that I've become familiar with over my career. So you can see the big spike here of inflation. The spike of inflation has caused the price at which mortgage bonds are desired in the market to increase, because if inflation is eroding the value of money, you have to charge more or offer a greater return on a long-term investment, or else it will. Why would anybody invest in a 2% mortgage bond when inflation's at 7%? You're going to lose money when your investment is cashed out. So that's the basic principle at which inflation erodes low interest rate environment. So the Federal Reserve is going to be very, very aggressive these days in raising the cost of money. We're talking about the Federal Reserve raising interest rates. That is to slow down the economy and reduce inflation. As inflation comes into control or under control, we're going to start to see that we could see mortgage interest rates benefit from that. We should see a reduction in rates. But in the meantime, I'm going to stick with the topic at hand and this inflation. Well, what has it done? Let's take a look at this next slide. The 3-month increase in mortgage rates is the fastest since 1987. You can look at this chart and you can see the bottom left here has got the March 1.56% increase in the last 3 months. You have to go back to 1987 to see an increase that fast. And I have to tell you, since the first week or so of April, we're definitely caught up to that 1987 and surpassed it. So rates have continued to increase. And here's why. Let's take a look. So I've referenced it once or twice. This is the mortgage-backed security. This is the trading. And I want to preface this by saying that if you haven't seen this chart before, this is a price chart. So as the price declines, the yield increases. Okay, so when you see a downward movement in this chart, or red on the chart, that indicates interest rates getting worse. All right, so I've put a couple of markers here on the chart for you so you can see that COVID if you look to your left here, we can see that huge V, very deep V that was formed. That's when the shutdowns were announced and the economy was basically ground to a halt. There was a week there where everybody was very uncertain as what was going to happen. The Fed decided that they were going to buy billions and billions of dollars of treasuries to keep interest rates very low, stimulating the economy and created that refinance boom that we all went through, right? Where we saw 2.5% interest rates on the 30-year. You can see that right in the very top of that plateau right there from COVID all the way over to today. That was the 18 months, 20-month period in which rates were at historic lows. Then the inflation hit, right? And we can go, not really touching on all the geopolitical influences, the war in Ukraine, the supply chains of the shutdowns, all of those things of what created the inflation. But the inflation hit, and the Federal Reserve only really has one mechanism to fight inflation, and that is to raise interest rates. And they're dumping all of the mortgage bonds that they purchased during the pandemic back into the market. So the Treasury's actually been holding onto those mortgage bonds, and now they're starting to sell them off at a pretty aggressive pace. How fast they decide to do it is going to have a direct impact on where we go from here with interest rates. But again, just trying to put a picture in front of you to illustrate the drastic movement that we've seen in mortgage rates. In fact, you can see here, this chart goes all the way back to the beginning or middle of 2017. Of course, there's volatility all the time in the trading, but if you notice, look at from the beginning of the year, which is right at the end of that plateau, till today, it's been going off a cliff. And that is unnatural. It's really not the way the markets normally behave, but it's in reaction to the Federal Reserve exiting the market in the first place. If you go back to looking at COVID, where I put the mark where COVID is, that's where the market was before the Fed got involved, pushed us up to this this historically low level. And now that they're exiting the market, possibly the market's overreacting and we're going to higher levels, but inflation is now a key element into the mix. So you can see we have not seen these levels since back in the fall and end of the year of 2018. Some of you may remember those days, but I made a little note there. That's the last time we've been in this neighborhood in the chart, but it was fairly short-lived. So here's a historical graph just to put some more perspective on this. If you go back to 2000, right, at the end of 2000, we were in the 8% range, dropped into the 7s, then the 6s, and we spent some time in the 5s, and you can see the 4s, the 3s, and then in 2020 and 21s, we were in the 2% realm. Well, that's just to give you some perspective that yes, in the short term, this is a dramatic increase in rates, and it's going to take our customers a little time to digest, but historically, we're still in pretty good shape. Now, what does this actually mean to your clients? Well, it means a lot, actually. If you were to have been looking at a $640,000 mortgage back at the end of the year, or even at the very beginning of this year, 3.75, the mortgage principal and interest would have been $2,964, call it $3,000. Compare that to today, it's $3,436. Okay, for that same mortgage at 5%. That's a $470 and change increase in the monthly payment. In fact, if you look at it, what would be the equivalent monthly payment? You'd have to reduce the purchase price from $640 to $560. Now, I tell you this just for a bit of realism, not trying to put a damper on anything, but if you have clients who have been shopping because of the lack of inventory, it's not unrealistic that people have been shopping since October, November, December, took maybe the holidays off and are back into the market. If they, for some reason, aren't engaged with their lender or having these conversations, it's important that we educate them And so they know when they find that dream home, the impact that that's going to have on their budget and possibly their qualifications. Not every borrower is maxed out on their qualifications when they set their pre-qualification budget. So this doesn't mean that they no longer qualify. But if you have that borrower who is stretching, who was stretching to get into a property, it is something you need to be mindful of. So I tell you that just to share this. I have other graphs if there's other things that you would like. I'm happy to provide that with you. That is all of the sharing of screen that I wanted to do. If you have any further questions, anything I can do to provide more clarity for you or your clients, I'm happy to do so to the best of my abilities. I hope you're able to follow the conversation this morning, and I appreciate you taking the time to watch this video and for all of your support throughout the years. Andy Wilt here, 619-717-7300. Thanks so much, and I'll talk to you soon.